Ladies and gentlemen, good day and welcome to Burger King India Q3 FY21 earnings conference call hosted by Edelweiss Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nihal Jham, Edelweiss Securities. Thank you, and over to you, sir.
Yes, thank you, Stanford. On behalf of Edelweiss, I would like to welcome you all to Burger King India's Q3 FY21 conference call. To introduce the management today, we have Mr. Rajeev Varman, CEO and whole-time director, Mr. Sumit Zaveri, Chief Financial Officer, Mr. Kapil Grover, Chief Digital Officer, Mr. Srinivas Adappa, Chief Marketing Officer, and Mr. Prashant Desai, Head of Strategy and Investor Relations from Burger King India. I will now hand over the call to Mr. Rajeev Varman for his opening remarks. Over to you, sir.
Thank you. Thank you very much, Nihal. Good afternoon to everyone. Thank you for taking the time to join the call this afternoon. And I hope that your families and your friends and your teams are safe in this very challenging COVID environment. Wish the same to all the families. I hope they're doing well. Look, this is our first call, first of many calls in the future, but this is the first call, and we're kicking off this call thanks to everyone. First, for a fantastic IPO entry. We couldn't have done this without all the investors on the call as well as all the analysts on the call. So thank you very much. But, you know, this is, as I said, the first call, which means this is a kickoff for us, very lovingly, I call it the ending of the beginning. And the journey really starts from here. Today our portfolio, where it sits in our vision to our, growth agreement with Burger King Corporation worldwide, is to triple the number of restaurants by December 2026. So that's the vision, that's the growth path that we're sitting on. So at 270 restaurants today as we sit, it's barely, getting started. And that's what I said, we're just getting started. So thank you again. And, there'll be a lot of good numbers discussed by both Prashant as well as Sumit Zaveri, and you'll get a handful of, information on both digital as well as marketing information. I just wanted to kick off by just giving you what's the obvious, which is January. We just completed January. We'll talk about Q3 through Sumit Zaveri and Prashant in a minute. But I just want to give you a flavor of where we sit in January. People have been comparing results with pre-COVID numbers, which is basically before COVID hit in. And if we do that with our business, we are about 99% sales recovered when we compare to this pre-COVID number. But, our team over here likes to look at it differently. We like to look at it SSG point of view. Where are we versus the same store sales versus last year? So when we do that, we have 85% recovered year over year in terms of sales in January. And this is led by our West business, which is recovered 93%. South and East business has recovered about 88%. And North, which has been challenged by different things, including, farmers, protest that's going on over there, which has kind of closed a lot of interrelating highways and so forth. And also in the last quarter of Q3, we had a lot of situations where certain areas where, because of COVID, there were a lot of restrictions in those areas. So North has had its challenges with this COVID as well as with the protests. So there, the recovery is only about 79. Also, I would like to share with you the recovery in delivery. Delivery, we have recovered 106% of where we were. So all of that business is coming. Dine-in, now that, the malls are all open up and the theaters are opened up, movies will come in due time. And as the movies come in, you will see that business will pick up as well. Dine-in is about 76. And given our company today, as we are a young company, this is our 7th year really, to be honest, getting into the business. And we have kind of grown this tall. It might feel like for the management team that we have achieved a lot, but there's a lot more to achieve in the future. And if you look at the portfolio that we have, it's slightly skewed towards, mall restaurants. So we have a whole bunch of our restaurants in malls. whether they're in the food court or in the malls, and those are recovering slowly. In fact, January was probably the best month where the malls recovered very well. But the last quarter, the Q3, you find that the high street restaurants, the more the high street restaurants, the better the company recovery was. So we were slightly skewed. Obviously, we're going to be building more and more restaurants on high street because we are done with most of the malls now. So we are looking forward to that and looking that in the forward direction. The second piece after sales is I just want to touch on profitability. Profitability at the restaurant level, the cash that flows out, the EBITDA that comes out of the restaurant, that for the Q3, the results were 8.8%, which is, rally against last year, it was 8.5%. A lot of work was done. A lot of work was done by the team, not only by, making sure that we worked with the landlords to get an effective reduction in rents for this quarter. Somewhere in the tune of 38 crores was saved by the team, and that helped the quarter as well. But also in addition to that, we did a lot of G&A work in terms of our rents in the offices, our relationship with our partners. Everything came to the table, and we were able to come out of this quarter on a company level flat or slightly positive, which is a good thing because we did about 163 crores of business in Q3 versus last year with fewer restaurants we were at 228. So complete impact of COVID. We are hoping that this will now kind of fade away over the next couple of months. So that's a little bit on profitability. And more detail will come in from just a little note on profitability also is on the GPs, and you'll see this as we kind of show you numbers. But our GP, as we exited December, the December GP on the exit was about 65%. And, that's a GP that includes food cost. It also includes paper packaging. It also includes transportation. Everything is in our GP. There's nothing that we report outside of the GP percentage. So it's a complete GP number that you're seeing. And growth, we continue to build restaurant in spite of the tough environment, and our net restaurant growth in this quarter was 10. And we have a fantastic vision to build about 50 restaurants in FY22, 70 restaurants in FY23, and 80 restaurants in FY24. So that's our vision is to get to 700 restaurants by December of 2026. So that's the plan. And this is, by the way, this company has been working on the plan from day one. So we have put a plan in place, and we have always overachieved on those targets. And we continue to do that. And save this COVID, which hit us, everything is going per plan if you remove this 1 year. And we're going to continue to move that forward as we move into the future years. So with that, and then the last piece I'm just going to touch on is marketing. A lot of work was done by the company in the area of food quality, menu items during the COVID months. Srini will talk about this in a few minutes, but the amount of work we have done on our Whopper, which is a flagship burger, a flagship sandwich, you have to just go and taste it now in our restaurants. I'd invite everyone to go to our restaurant, and whether you're vegetarian, non-vegetarian, go and see what we have done with the Whopper. It's a fantastic product that we have built, and I know that once the business is back, people will love to. And we did a fantastic campaign behind it, which Srini will also talk about. So we did an entire campaign, a menu, uplift, whether it was this Whopper or the gourmet menu, which also Srini will talk about in a minute. And then final piece is we also launched our new app, which is an omni-channel app. You will see that it's first of its kind app in the industry, which actually includes, loyalty program in our space, in the QSR space, in the burger business space, is the first app that will have the loyalty program in it. And Kapil will take you through the digital aspect of this, of what we are doing. It's just new. It's just out of the covers, and what he's going to do with it over the next several months. So this is basically a little bit of my introduction. I think the meat of the material will come both from Sumit Zaveri, Prashant, and Kapil, and Adapa. So I'll turn it over to Prashant to carry you through the first piece of this presentation. Over to you, Prashant. Thank you.
Thank you, Raj. Friends, since this is our first call and interacting with most of you, what we thought is we'll share with you two, three significant differentiators that we've kind of built into the business ever since we started to help you kind of understand how we think about this business and why we think about the business the way we think. So principally, we were, as Raj mentioned, we opened our first restaurant in 2014 November. So we are almost 20 years after a lot of the QSR players had entrenched. And when we entered into this, we decided to build and structure this business a little different than a lot of other players. So if you go to slide number 6, the way the Burger King India business is currently owned, it's owned through a holding company called QSR Asia. QSR Asia has principally two large shareholders. One is BK Asia Pac Pte Limited, which is the Burger King Global Corporation. And the reason why I'm sharing this with you is this is probably the only QSR currently in India where the franchisor owns equity in the franchisee's business. And this was extremely important to us. And the reason why it was important is because we wanted to align the franchisor and franchisee's interest together. And that's how we've done what we have done. Second large shareholder is F&B Asia Ventures as a platform out of Singapore, which has, besides Burger King India, it also owns Burger King Indonesia, Domino's Indonesia, Harry's in Singapore, and few other restaurants, which in turn is owned 45% by Everstone, the private equity group, and 55% by LPs of Everstone. So this is one way we are different, where the franchisor owns equity in the franchisee's business. As a result, what we have done, and I draw your attention to slide 7 for those who have the presentation in front of you, we signed what we call as a Master Franchise Development Agreement with Burger King Corporation globally. The way this agreement is different than a lot of other agreements is under the MFDA, both the brand and the business are executed by us sitting here in India. And when I say brand, I'm not purely talking about marketing and communication. When we look at brand Burger King, we look at it more holistically. The MFDA that we signed with Burger King Corporation gives us absolute flexibility when it comes to decisions on menu, when it comes to decision on pricing, and when it comes to decision on supply chain. So we have absolute flexibility when it comes to that. Second thing we negotiated with them was take the rights for the entire country. So we have pan-India rights to open restaurants, and then you will see both what we have executed and our runway will be very, very aggressive because we have the entire country to do that. We also have the rights to sub-franchise the restaurants, though very far and few in between we do that. But if we want to do that, that option is available with us. We've also negotiated what we believe are favorable royalty rates. Up till 2039, our royalty rates are capped at 5% plus GST. And like all QSRs, we also spend 5% of our revenues on marketing. Against this, what we've agreed with Burger King Corporation globally is to open 700 Burger Kings in India by December of 2026. So these are some of the advantages that come to us under the MFDA. When it comes to expansion, as you all probably would have read the DRHP, we are the fastest growing QSR in India. We were the fastest to 200 restaurants in the first 5 years of our existence. And a lot of this we have done focusing on what we believe is a cluster approach or a cluster strategy. We opened our first store in Select City Walk in Saket, moved around Delhi, then moved to the NCR belt, then moved to Punjab, then moved to Haryana, consolidate our presence today. We are the number one and dominating brands within this side when it comes to North as a region. Ditto with the West, we started with Mumbai, went to the Mumbai metropolitan area, then went to Pune, Nasik, Nagpur, so on and so forth. Ditto with South, Hyderabad, Bangalore, so on and so forth. So from our side, this is one discipline that you will always get. All the incremental expansion that Raj spoke to you guys, you will see almost 70% of our expansion will come within the existing geographies that we are present. And we'll obviously keep experimenting with new things, but that's the discipline that we follow because we believe QSR as a business is a business which you will have to save the pennies to make money. And this strategy helps us maintain our supply chain and distribution costs significantly. Raj has already spoken about our expansion plans. I'll quickly tell you. For FY22, we'll open 50 new restaurants. These are net additions. For FY23, we are planning 70 net additions. And for FY24, we are planning 80. So in all, over the next 3 months, we are guiding that we'll open 200 more Burger Kings in India. With this, what I will do is I'll quickly hand it over to Sumit. Our CFO will quickly take you through the business and the financial updates. Sumit.
Sure. Thank you, Prashant. I'm on slide 11, and some of the things that I'm going to talk about, Prashant and Raj did cover up, but I just kind of quickly go through these sections on finance and then hand it over to marketing. bit. I know obviously all of us have been impacted by COVID, and we've consistently seen, as the markets have been opening, we've consistently seen the recovery to come back. Quarter 3, our recovery as compared to last year on a YOY basis was 65%, and we've continued to grow strongly thereafter. In the month of January, we were at 85%. And the reason why I really kind of also referred to the amount of 65% is when we get to the financial section, I'll be able to kind of correlate that number well when we try to correlate it with the performance that we've been able to achieve during quarter 3. Just that, to get better understanding of what has been our recovery been with respect to different markets. And we've very clearly seen very strong recovery in West region. While all regions equally got impacted, but we've seen the opening in this market being fairly gradual and continuous, and that has literally helped us to get to a continuous positive recovery, reaching to 93%, followed very closely by South at 88%. We've seen effectively, the impact of COVID, where lockdowns were reinforced in some parts of North and some other issues in terms of farmer protests. We've seen that recovery to be slightly slower. But at the same time, January, we've seen that market has also gone closer to 80% in terms of recovery. Our business, traditionally, we've always concentrated on dine-in and delivery as the two verticals for the purpose of our growth. And this has been our philosophy from the time we entered the market. As we speak today, our delivery stands at 38% with a recovery of 106%. And as a share of revenue, dine-in stands at 62% with a recovery of 76%. And when we really look at this number of 76%, as we stand today, literally we look at it from the perspective of saying what do we see it to happen in terms of going forward. And Raj initially was talking about, saying that today there are still some limitations with cinema yet to open up, the transport in terms of metro or intercity transport still kind of coming back. Schools, colleges are expected to kind of open up over the next 2 to 3 months or so. We very clearly see that opportunity in terms of the recovery of dining to get positive as we see some of these elements of a larger economy to open up, which also impacts our business on a positive front. I'm on slide 14, and this is something which we just kind of put it as a reference point to see where do we stand with respect to pre-COVID sales. While, as Raj initially explained, we would want all of you to understand really performance vis-a-vis last year, because that is a true reflection. It also talks about adjustments that could happen on account of seasonality. But as a reference point, we are already over close to pre-COVID levels in the month of January, touching 90% plus for the month of December. Since I've already spoken about recovery, that's on slide 15. Earlier, since we already spoke about recovery, and this is SSSG is literally the reverse of the recovery chart that we spoke. So I'm actually at this point in time not talking about that. And quickly going through slide 16. While all of you understand that there has been change in the accounting standard where these accounting standard has changed, but for you to get better understanding, slide 16 we are effectively kind of talking about the traditional approach of EBITDA, and I'll just quickly take you through that. As far as quarter 3 is concerned, we did a revenue of 163 crores, which was effectively a 69% growth over last year. And as compared to 69% growth over quarter 2, and we were at 72% year on year last year. But what is relevant, and when I was talking to you about keeping a note of SSSG or of quarter 3, is that at 65% recovery that we got at quarter 3, we could still achieve a company level break even for quarter 3. Obviously, various initiatives that we have taken on the cost front and kind of managing the margins with all the challenges at 64% has actually helped us to achieve the break even point. As Raj was talking about earlier, we've always believed that it's just the beginning. We've already made an improvement on our gross margin by exiting at 65% for the month of December, and we've only continued to improve. We very clearly see that gross margin will kind of expand as we continue to grow our business going forward. As a reference point for all of you to kind of do a comparison, EBITDA under the reported financials and after considering the impact of these is 24 crores or at 15% as a percentage to revenue. So with that, effectively, and as far as the published financials is concerned, since they are available with you, I'm not getting into the details. And with that, I'll hand it over to Srini to talk about the marketing aspect, the brand aspect, and the various initiatives that we've taken on that front. Srini.
Sure. Thank you, Sumit. Hello, everyone. We kick off the marketing section. I'm starting with slide 19. Raj has touched upon it, and just to give you a context, when the whole COVID and the pandemic hit us, the team here at Burger King, we looked at it as an opportunity to, review and dial up our taste and quality credentials across every part of our menu, right? The core team here literally sat through and did the job systematically across every menu item in order to dial up our taste, right? So what I'd like to share, looking at slide 19, are a couple of big initiatives as we dial up food and quality. October, last quarter, we've launched our new Whopper range. Whopper happens to be Burger King's global power brand. It's our flagship offering. While every burger is good, we believe the Whopper is better. Not just because it's got a flame grilled patty or it's got a combination of sauces and multiple ingredients, but the fact that it's a full 7-layer indulgence, as we call it in our campaign communication. So we've launched a whole new range of Whopper. The veg Whopper now comes with a much crunchier veg patty, and the chicken one, we've made the patty much more juicier. Of course, the combination of sauces makes it the whole nuanced, indulgent experience that it is. Not just the main core Whoppers, we've actually extended the brand to make it more accessible. We've got a range of junior Whoppers, both in veg and chicken, at a very attractive price point of $99. Moving on, we've also added another new layer on the premium side. This is something which we call the King's Collection. And the whole insight were to offer our guests hand-picked premium, best-in-class burgers from Burger King. Right? Be it the cheese-infused cheese meltdown or just a new exciting take on the paneer. Again, these are something that one has to experience. Really excited about this premium range, so I would invite you folks whenever you have an opportunity to try that. A little bit on campaign and communication. Referring to slide 21, I touched upon Whopper and its superiority. The campaign that we launched in December is all about the Whopper. It's something which we call, it's not a burger, it's a Whopper. In fact, when we were coming out of the lockdown, we wanted to put our best foot forward in terms of going on national media, and we had this brand new range of improved Whoppers, and this is what the campaign was all about. We obviously were on national media, we were there on front page of newspapers, and at critical sites on out of home as well. We are, referring to slide 22, Burger King is a Gen Z brand. We do a lot of work with young consumers, and that's where our brand love lies. And we've done some really good work, which got some good anecdotes from external parties that I'm happy to share. In fact, Bloomberg Quint listed as amongst the top 10 social media brands, competing with other equally exciting brands. So that's again a very integral part of our brand, high engagement platforms on digital, where we interact with Gen Z audience. And the next slide really just wanted to confirm, we continue to be vigilant on safety and on our test and trace protocols, our sanitization frequency, our social distancing norms, and other measures that we've put in place during the pandemic. We continue to endorse them across all our restaurants by our operations team. So that's a quick update on marketing. I would pass on to Kapil to share a bit on the digital ecosystem front.
Hey, thanks, Srini. Good afternoon, everyone. While we strengthen the brand and make the brand more accessible to our consumers, one of the big strategic focus areas for us in the coming quarters will be to build a branded omni-channel digital ordering ecosystem for our consumers. As Raj mentioned, we've just rolled out a brand new Burger King app. On the technology side, on the customer convenience side, we're making sure that this is the best-in-class online ordering experience for our customers. A light and fast app with all the features that customers would need to make a frictionless ordering for Burger King products. We're right now test marketing this in a city, and as we sort of build all the features out and fine tune the product, we'll be scaling this up in the following quarters, and we'll have a lot more to share in the coming calls. With this, I'll hand over back to Prashant to share the closing on the.
Thanks, Kapil. Guys, at Burger King, we've also decided to kind of give you guys some form of guidance also from a perspective how we kind of look at this business. So two things. One, we will give you a 1-year forward guidance, which is on page 25. Along with that, we'll also give you a 3-year rolling guidance. We are currently restricting the guidance to 3 particular aspects. One, essentially, which is the driver of this business and the business model, is expansion. So currently we are guiding that we'll open 50 new stores next year, 70 thereafter, and 80 in FY24, which will take us to end 24 with about 470 stores. As you guys know, SSG is extremely important, and that's one more guidance that we will give. As far as FY22 is concerned, our guidance is we believe that we will be back to our FY20 levels of ADS. We are not currently factoring any growth over FY20. However, if our numbers change, we'll come back and revise this as we move forward. From FY23 onwards, we are currently guiding a range of between 5 and 7% in terms of our SSSG growth. We believe the quality of the business is the quality of its gross margin, especially in the QSR space. And for FY22, we are guiding a gross margin of 65.5%. And 2 years forward, we are guiding 150 basis point improvement over this to about 67%. And as we said, these are guidances. If there is a significant change in them, we will revisit them as we interact with you every quarter. I guess that's what we wanted to interact slightly longer because this is our first call. What we will now do is request the host to open up for Q&A. We are here to take your questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Also, as a reminder, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have additional queries, you may join the queue again. The first question is from the line of Manoj Menon from ICICI Securities. Please go ahead.
Hi team, absolutely, pleasure. We're happy to, listen to your story. Pretty exciting. Just a couple of questions to begin with. One, when I just generally look at the template, what at least we are used to, because, being an analyst who actually did the Domino's IPO 10 years back and then, tracked the Westlife for the last few years, it's been quite interesting to observe that, Burger King, the contract what you have actually has got a target of 700 stores. Which is something which at least I have not observed in the other contracts, either in India or in my earlier life, looking at some of the global aspects as well. So just trying to understand, where does this 700 number come from? And that is quantitative, and qualitatively, what is the drivers for you to kind of commit to a number to begin with? Because that doesn't really appear to be industry practice. While I honestly speaking, that said, as an analyst, I'm very happy that when I think about the modeling, having a number of 700 does help me, have some sort of a view on how does the next 3-5 years should look like, because there is a contractual obligation. So I'm not, constraining my thought as an analyst. I just want to understand the thoughts behind these numbers. So that's point number 1. Point number 2, generally on gross margin, but this is for the larger audience, so when I just actually benchmark your gross margins with the, the other 2 peers listed companies, and also, couple of the unlisted, understanding what I have about how their gross margins look like. Just trying to understand, okay, just to be a little more clearer on this. So, being a relatively younger company, that's point number 1. Point number 2, as a consumer, as I correct me if I'm wrong, Burger King, I would observe it as actually as a discount brand. Point number 3, relatively lower beverage contribution. So I'm just trying to understand the drivers of gross margins as of today. Yes, if that that gets responded, obviously, we could look at how does it look like in the next 3 to 5 years. Thank you.
Yeah, thank you very much for your question. Very good questions, both of them. First of all, I'll address the question on the targets. On the onset, I shared with you that we have been a planned company from day one. On day one, when we funded the project, when we put the team in together, we didn't start to build the first 10 restaurants. When we put the team together, we had the vision to build 700 restaurants. Very simple vision to grow the business, to build 700 profitable restaurants, and to drive, a cash flow from those restaurants. That was the simple brief. And we put a fantastic team. I mean, I tell you that the biggest asset, if I can speak over here for 2 hours, I would speak about my team. And we have got professionals leading the growth. Everyone's heard of Mr. Gupta. He's been on several, different magazines and articles. He drives the growth business over here in India for us. So we have a plan in place to grow. When we did the study, and I'm talking about 2013, and this was a study we did with McKinsey. At that time, the total size of the market for a new brand like Burger King was shown anywhere about 1,000 restaurants. And then we kind of took that number and we put on a piece of paper, on a map, how many restaurants we had built. So today, if you ask Mr. Gupta, he will tell you what he's going to build, which area he's going to build on an ongoing basis, which geography is going to go in there, what types of restaurants. So it's a complete plan that we put in place, and we kind of go about planning. See, we look at this as a science. This is not an arts business, it's a science business. We have our formulas on, what the kind of retail is there in an area, what the trade area can afford, and so forth, and we build based on that. So that's the driving force of our commitment. By the way, I think that this is a privilege for us in our MFDA agreement that we can build 700 restaurants so quickly. So that's the answer on that. The second question you had was on margins, and I can tell you that we have in addition to a very effective supply chain team, which is led by Sandeep Dey. The work that is put in here is about 20 years of experience behind supply chain that gives you the relationships with different suppliers and so forth. But the main driving force is the strategy that Prashant was talking about on one of his slides. It's the strategy of growing in clusters. We don't, we are very disciplined the way we grow. We don't go and put on, restaurants in remote areas which will bring down the gross margins because of increase in transportation costs. We have a very disciplined way that we grow our business. And every time we build 70% of our restaurants each year in controlled markets where we are already there. This significantly reduces our distribution costs, both primary and secondary, because the primary costs, in a dense population area where more food can go there in less trucks, and the secondary distribution because now you can distribute on one ring 6 to 7 restaurants. So both those get impacted, and that's predominantly. Now the opportunity is something that you guided on is we haven't gone into the cafe business as yet. That's something that's open to us, and that's a 80% kind of a plus business that we can do at any point of time and push that thing forward. In fact, we will be looking at that very seriously very soon. And then there's so much else that we do. But I wouldn't say that it's a discount business. I would rephrase that as we are a value leader. We want to continue to be a value leader. We want to be a business that people come in and eat the product and say, this was worth the money I paid for it. So that's a value versus being a cheap business brand, a value brand. But I think Adapa did a fantastic job. It was only one slide. I wish I had more slides to share with you. But, we have built a fantastic gourmet business on the upper side, on the upper end of our menu. So it's a barbell strategy where we have a decent value business and a very strong business on the upper side. So that's what helps us drive a very good GP and the fact that we grow in clusters. So I hope that answers both your questions.
Thank you. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, Raj, Prashant, and team. I had 2 questions. One was, the context of your expectations on ADS. Now, you have argued that FY22 ADS would be similar to FY20. but this is despite, if I'm correct, new store contribution or new store share is actually moderating. Is this because you're expecting ADS on same stores to decline, or is it related to the recovery in new stores being lower? If you could help kind of explain that.
Yeah, Prashant here. Just to kind of build a perspective, when we were sharing that same store, I was sharing the same store at a portfolio level. Anyways, the new store that I opened get into same store only in the 14th month. Where we are sitting currently and the way we are seeing life and where we have decided to guide you guys, our view was that by February, March, we should be back to at a portfolio level to an ADS that we had seen just before COVID hit. And our view is that if we are able to maintain that in FY22 along with the new 50 stores that we will open, I think we should still be able to deliver you a reasonably interesting performance. And as I said, this is a moving target every 3 months, 6 months. If the situation, things on the ground change, we will revert back. So the SSG when we were talking about was on a portfolio basis, not factoring into account the new stores because they get into same store only after about 14 months.
No, sir, but I'm sorry, just to harp on this a little bit, the ADS that you've mentioned is on an overall store basis, right? So FY20, whatever was the average daily sales is that on all store basis or only on same stores?
So that's only on the existing stores, the stores that were operational at that point of time.
Correct. So in the operational store have going to kind of rise, and yes, you're arguing for ADS to remain flat. Now, what I was trying to split this further is the contribution or the drag which would come from new stores that were added 2 years, which are only less than 2 years old. That share of or that proportion of stores in FY20 was higher than what it would be in FY22. I mean, correct, simple average, right? So by that logic, just because of the age of the store maturing and kind of becoming more and more same store, I would have thought that the ADS would move up. That is where I was coming from. And, the recovery levels, by FY22, I'm hoping things kind of, is that, or are you just being conservative? That's why, that's the context.
Yeah, so one is absolutely, we are conservative in whatever outlooks we will provide. That's number one. Number two is we're getting off a COVID year, right? That today the vaccines are just coming into the market, and they're going to take the next 6 months kind of getting into the mainstream, so forth till then. Today, again, when we shared the numbers for Q3, leaving alone January, we are at 85% recovery. 93% recovery in the West, and I give you those numbers, right? So we'd watch these numbers. So we're still not 100% year over year recovered, right? So for us to guide you in a bigger way would not be responsible. And I think as a team, as a team, we are saying let's get into the next year. Let's make up the 100%, and then hopefully the last 2 quarters will be, and that's why Prashant said we will continue to guide you on a quarterly basis. The objective is very simple: is not to throw out numbers and visions and headlines. The vision is to be a responsible company and to continue to grow as we have planned, and we continue to be very conservative in our planning, and we would like to always deliver higher results. Is there anything you would like to add? So thank you for that question. Appreciate it.
Just one bit, sir. Just the last question from my end, if I may. Your digital initiatives. I mean, I see it's a slide on the front end investments. If you could just give some sense on the back end investments that you are doing to support them, and just a comment just before closing is this has been a fairly very intense presentation, a very useful. You've been fairly candid, and I really appreciate it. And I look forward to kind of you continuing this. Thanks. That's just
Thank you. Thank you for those comments. I really appreciate it. What I'll do is I'll flip it over to Kapil. He will give you the back end. Look here, for me, digital is not just about the app that he's going to talk about. This company, digitally, if you look at it, our vision with this digital is 360 degrees approach. That is digital towards the consumer, digital towards our employee that are managing the business so that they have apps to monitor and run the business on a daily basis, digital towards our suppliers so that the suppliers are able to do everything, communicate with us completely digitally. And then also digitally towards our franchisor so that we are constantly evaluating the business, constantly getting updates from different markets and so forth. So it's a 360 degrees approach to digital, and a lot of investment over the last 6 years have gone into putting all the structure in place. Our supply chain, connecting our stores directly to the DCs, to our suppliers, all that is in place. So that, and then the back end on the app and how we're taking the digital to the consumer, I'll turn it over to Kapil.
Hey, Avi, thanks for that question. I think what Raj mentioned is absolutely correct. On the app, we're just about getting started. I think what we've done is that we will make sure that the core competencies, whether it's on data, on digital marketing, on CRM, we'll build those in-house while we work with our partners to build more capabilities around digital marketing and extend that support. But this is just the start, and we will grow this business. It's a strategic priority for us, and we'll make the necessary investments to grow this.
To answer your question from a financial standpoint or a balance sheet implication from a capex standpoint, it's nothing significant that is going to move the needle. All those investments have already happened. What you will now see going forward is now that the app is kind of almost getting there, you will see us spending on the front end on the marketing side of the app. So from that perspective, rupees crore capex, nothing significant.
It's all OPEX from here. The capex is already done.
Okay, so even the back-end capex in terms of commissaries, in terms of supply chain, that is all there. Okay, sir. Thanks, sir. I'll come back in the queue for others. Thank you very much, sir.
Yeah, sorry.
Next question. Yeah.
The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good afternoon. So my first question is on your same-store sales guidance. So the guidance of say 5 to 7% from fiscal 23. Now, what percentage of this do you expect to be pricing, especially in the context of sort of very high store expansion? We've seen with some of the other players that when you have very high store expansion, you also get an impact of store splits or consumers shifting from to a closer store. So how do you think of when you make that 5 to 7% guidance? How are you thinking of pricing versus volume?
Sure. So Aditya, if you will see our historical context about 4-5 years that we've actually run the business, on average between 3-4% is the price hike we end up taking. It's done intelligently so the consumer doesn't feel it. So that's the kind of 3 to 4% price hike you can expect us to take. Along with that, balance is the the traffic growth that you can budget for. And our view is that if the country is going to grow at 5 to 6% of the GDP side, that's the kind of guidance we are currently comfortable with. Unfortunately, a lot of status quo has now changed post-COVID, and we don't know how strongly will India bounce back. And if we see a very strong bounce back, as we said, we'll come back and kind of revise this guidance upwards.
Yeah, thanks. The reason I asked that, I mean, if I look at the SSG history, right, and this is not just for you, but even for the other listed players, you had very strong same-store sales between 4Q18 and 4Q19, and part of this was just the price cut driven by GST, right? So I mean, obviously, just a small change or whatever 10% change in pricing led to consumer pricing led to a huge improvement in SSG across different players. So in that context, I mean, if volumes were worse, then would you consider maybe sacrificing that 5 to 7% SSG target by keeping pricing flat and just to sort of drive volumes?
Yeah. So first, in reaction to your question is, we never included GST in our pricing ever. So GST was always on top of our pricing in the past. So the growth that you saw, the 29% growth in traffic and sales. So it was just not in sales, it was also in traffic, was purely driven by more people coming into the restaurant. And that was the year that we had launched our value strategy. And you saw that pretty evident that the 2-year comps was probably one of the best in the industry. So that's the first part of your question. Now moving forward, I think guidance that Prashant was sharing is kind of the guidance that we have been doing with our business before even we were public. We continue to follow the same thing. We like to be a little shy of the inflation rates in the company. And every time we take some pricing, we find a way to add some kind of value to our burgers. So we're not kind of just growing the price scale. We change the menu, the layout of the laddering of the menu. We do a lot of things to make sure that there is no direct impact on the consumer. So pricing is a complex strategy. It's just not about just taking price hike on products. It's about rearranging the menu. So we do that effectively on an ongoing basis. And I think, all the growth numbers that you will see in the future will include that same split that Prashant gave you, which is about 4 to 5% kind of a pricing hike, and the rest of it will be on traffic increases.
Okay. Fair enough. Very, very clear. Thanks. And the second question on gross margins. Again, I mean, here you guided to slightly higher gross margins. Would this be a function of just better mix and efficiency, or again, slightly driven by pricing as well?
No. So I'll tell you that if this question is asked to our supply head, he will tell you it's a multiple of things. We don't drive, one-liners to drive, efficiency in a supply chain. It's like I said, it's a growth strategy. For example, I'll give you a very quick example because I think you're asking the question after I try to explain it, so maybe I didn't do a good job. If you're taking a city and we have 25 restaurants in that city and we have a DC, the DC's overhead cost is spread over those 25 restaurants. Now, when we grow those 25 to 40 restaurants, it's spread over 40 restaurants. Suddenly, you find a decrease in the total food cost going into those restaurants and hence an increase in GP. So that's one of the things that we do. Second is we continue to do what we call as menu architecture. So that's the second element that drives, GP. It just doesn't drive the sales of product. It just doesn't drive the pricing of product. It also drives the total profitability of the company. So that's the second thing is intelligent menu architecture. And third is there's not a year that we don't go back and look at our menu and look at our suppliers and find new suppliers. We are always looking at making sure that we are buying efficiently and that we are supporting our restaurants in the best way. So all three elements and many elements beyond these three elements that goes into our cost effectiveness and our GPs. I hope that answers your question.
Yes, it does. Thanks. That was very clear.
Thank you. The next question is from the line of Vicky Punjabi from JM Financial. Please go ahead.
Yeah. Hi, sir. Thanks for taking my question. I just had two aspects. One was on your cost. Basically, if I look at the P&L, last year your other expenses kind of stood at 83 crores, which is down to 57 crores in this quarter. I just wanted to understand, what out of these, I know some part of it is actually related to the rental concession. But I just wanted to understand out of this 27, 28 odd crores, what kind of, are there any savings that could actually sustain even once we see the full recovery?
Go ahead.
Yeah, sure. Second question, just very quickly on the SSG part of 5 to 7% again. Given that your store expansion pace is much higher, that does sound a little conservative to me. Because generally, given the higher quantum of stores that would be non-matured in your portfolio, the SSG growth, should be actually, kind of helped by these non-mature stores. So just wanted to understand your thought on that. That's it. Thank you.
Thank you. Thank you, Vicky. So, Vicky, yes, we have seen substantial efficiencies on the cost side, and that is thanks to the initiatives that we took across all cost lines. The cost reductions that we've got are combinations of reductions on account of negotiations that we've done during COVID period, and those would kind of over a bit of time will keep getting phased out as we get to normalcy. But the idea when we went into a lot of these cost initiatives was to really kind of support the business through this period. At the same time, I wouldn't say that we will not see a continuing effect in some parts of the costs going forward. But as far as the rent line, which was a substantial part, we would see to an extent kind of going back to the normal levels as the business really kind of goes back, because the larger substantial part of that savings was towards the period of COVID there. But at the same time, simultaneously, we've taken several initiatives on the cost side where we would see savings going into the subsequent periods as well. Coming on to the SSSG part, and that was something which I think Prashant did try to answer earlier as well. We are just getting out of, honestly, out of COVID period. And we are effectively kind of, at this point in time, as we see market, we feel that that's the reasonable number, which is aligned to where the GDP growth rate expectations are to keep as far as the SSG growth is concerned for periods going thereafter. As we see some of the tractions of the faster recovery, I'm sure we will come back and guide the market differently going forward on the SSG side as well.
And Vicky, if I can add to what Sumit was saying, and this is something for the interest of everybody on the call. If you structurally see, Vicky, March of 20, and if you see our rent to revenue ratios, you will see they were at almost close to about 15%. And if you look at our store breakup today of 270 stores, almost 50% of these stores we opened in FY19 and FY20. And in FY19 and 20, that entire portfolio opened at a rent to revenue of between 12 to 12.5%. And this is one of the things that we've trying to explain to our investors also during our roadshow, that as the business begins to scale up, these are the two massive leverages that you will see from an operational perspective. One, obviously, our gross margins are moving northwards. We are guiding for almost 150 to 200 basis point improvement there. Second, you will see the rental cost as a percentage of revenue coming down as we move forward, both because of the portfolio that we signed and got operational, plus as my revenue begins to scale up. So these are the two levers you will see significantly moving the needle on the restaurant operating side.
Sure. Thanks, sir.
Thank you, Vicky. Thanks for your question.
Thank you.
We can take another question.
The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir. So just wanted to understand a few aspects, like in terms of gross margin, you have spoken a lot. So just wanted to understand, like as your stores count increase over next 2 to 3 years, and even with improvement in gross margin, how does that translate in terms of your improvement to your EBITDA margin? So some comment on that would be quite helpful.
Yeah. So I think Prashant outlined when he was putting up his slides the expectation to get to 67% gross margins in 2024. See, when we talk about our gross margin, I would like to reiterate and reconfirm to you guys, it includes food cost, it includes paper and packaging cost, it also includes the transportation cost, both primary and secondary. So that's how we operate our business. So it's all in there, and that's how we read it, right? So as we move there, our vision is to continue to grow that. There's not going to be a year where my team will not have a target of improving GP, gross margins. There will not be a single year in the future where we will not continue to drive that. So I think earlier on, someone was, I'm trying to remember who it was, but someone was saying that, there's beverages business you're not in. How do you deliver without that business? So there's a lot of just organic things that will be coming into the business which will drive gross margins in the future. But that withstanding, we also have a lot of things we have to do within our company because we are new. We are efficient, we are new, and there's a lot more efficiency we can build out of this efficient team. And that will also continue. So our gross margins will go both because of the kind of business we will do in the future, what kind of stuff we'll bring in, and it will also grow because we will bring it in much more efficiently.
And Deepak, if you overlay what I was just telling Vicky previously, that we are guiding for almost a 200 basis point improvement in the gross margin. Plus, as I said, there is going to be operating leverage on the rental side. And if you factor this, I don't want to put a number to this, but you will see even from my FY20 numbers of the restaurant level EBITDA and the company level EBITDA that we spoke of, the numbers in FY22 itself will be massively northwards to what we've delivered in FY20.
Okay. So at restaurant level EBITDA, we are at about maybe 8.5%, 9%. But on the company level, maybe excluding the impact of AS 116, we are at about barely breaking even at maybe 0.5% kind of thing. So what you are saying is that we are seeing extremely northward kind of a movement as we build up scale and as we improve our GP as well, right?
That's true, because this nature of this beast is that, yeah, it's a very high operating leverage beast. As you begin to open more restaurant, your corporate cost gets apportioned over and above that. As you build scale, overall matrix of the business changes. We were at a disadvantage, I mentioned in the opening part of my remark, because I came 20 years later than most people. So I unfortunately came at a time when the rental costs in this country were high. So if you go back in 2015 and 16, my rent to revenue ratios are northwards of about 18%. Now we've kind of brought it down to 15. And as I mentioned, we signed almost 50% of our current stores are signed between 12 to 12 and a half. And as these stores begin to contribute, you will see these leverages coming in. So yes, give us a couple of years time and you will see these numbers will be very different. As we get advantage from the scale for which Raj mentioned, we saw the vision from day one itself. The founders, the promoters put in close to about $100 million in this business to grow this business to this size and scale. So you will see all these advantages starting FY22.
Starting FY. Understood. That's it from my side. All the way best. Thank you.
Thank you, Deepak.
Thank you. The next question is from the line of Sanjay Chawla from Emkay Global. Please go ahead.
Hi, thank you for the opportunity. My first question is, if you could just take us through the unit economics or the store level economics, in terms of capex and revenues in the first year, and how that sort of scales up and the various break-even points, etc.
Sure. Sanjay, though unit economics I will have to get into ADS level, which for competitive reasons here we don't want to share. But if you do a pure maths, you will get it here. Structurally, at a store level, our paybacks are between 5 and 5.5 years. And our capex, if you would have read in the DRHP, it's about 2.8 crores per store. We run a negative working capital business, so our effective capex is roughly about 2.5 crore a store. And then you overlay to this that we kind of recover this 2.5 over a 5 to 5.5 year period, and you do your maths, you'll get the number.
Okay, fair enough. Thank you for that. And the second question is, what sort of a capex, one should expect in fiscal 21 and also fiscal 22, and the breakdown of capex into new stores and maintenance and also upgrade/delivery?
Sanjay, good thing for us is we are a young brand, as somebody else also mentioned. We opened our first store in November 2014. That year we only opened about 13 stores. So from a refurbishment capex perspective, we get into that in year 7. And that year 7 also, that refurbishment capex is largely front of the house in terms of a little bit of the furniture, etc. So no, you will not see any massive significant refurbishment capex at least till 2024-25. In terms of our capex on an annual basis, I've given you the guidance of about 50, 70 and 80 stores. Multiply that by 2.5 crores, that will be the net capex that I will be doing. Also one thing, and you guys will do the math, if you see our EBITDA to operating cash is almost 100%, which is where I was saying our refurbishment capex is almost close to negligible, at least for the next 2 to 3 years. And that will also be the case because of our accumulated losses. We don't see us getting into the tax bracket at least till 2025 or 26. So all the EBITDA that we generate is our operating cash.
Okay, great. Thank you very much and all the best.
Thanks, Sanjay.
Thank you. Ladies and gentlemen, we take the last question from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, thanks for taking my question. My first question was on this delivery. When you first set your business, as you rightly said, when you started, you had a 700 store thought process. Now, since then, obviously, the aggregator model has come up. Delivery has become a lot bigger part of the food pie. So how do you think of this 700 store count now versus 5-6 years back? Does it mean you can cover a lot more area or geography using the same stores, or is there any change in the size of the stores and stuff like that to take care of this new development which has happened over the 5-6 years?
Yeah. So, you're absolutely right. Your question is bang on. Every year, we see this potential increasing every single year. Every single year, that 700 target seems like a very small target versus the market increase. And this is due to 2 things. One is, the disposable income of families. Let's not talk about COVID year. Let's keep that aside. But if you're talking about everything that happened before that, disposable income is increasing dramatically. You have the millennial population, which is the population between 15 and 35 years, which is our TG audience. and I've been running the brand all across the world, and this is the first time in a country where our TG audience is the largest share and the largest growing share of the population. It's also the population that eats out of home more often than other populations. So these are the reasons that they have more disposable income, they have less time, and plus on top of all this, this is the population that actually goes out and eats a lot. So if you put all that together, this market is actually growing much rapidly. If you look at some of the Technopack studies, you will see that the growth is expected in high double digit over the next 5 years. Every time we give you numbers, they're very conservative, but that's the approach we take in our business is to build a business strong, to build a business with humility, and to continue to grow the business with a lot of humility in the business. And so this market is growing, and our potential to put more restaurants in very heavy cities, I'm just giving you an example, in Mumbai or in NCR, is growing every day. There's new and new localities coming up. The highways are now producing more and more sites that were never there before, because these rest stops are coming up on highways wherein food courts are being built and you can go in and put your restaurant there. There's a lot of more activities going on with the airports. There's a brand new terminal, for example, in Bangalore Airport, the international terminal coming up. So a lot more activities going on in that space as well. So we see this growth not only because of the market which wants more products from us, but also because of the infrastructure is providing that kind of capacity for us to grow. So you're absolutely right in your remark there that we see this growing on an annual year-over-year basis. So we are very comfortable that that 700 target is actually well achievable.
Okay, thanks for that. And yeah, please go ahead.
So I just wanted to request Edelweiss to open up the call for another 15 minutes because we took up a lot of time in explaining in the initial part. So if there are further questions, Nihal, we can keep the call going till 3:15.
Absolutely.
Sure, I'll do that.
And just one last question from my side. So one observation was that your ADV in delivery picked up to only about 85% in the December quarter, while some of your competitors had seen higher pickups, but you've seen a big jump in January while others seem to have stagnated. So any reason why your pickup was actually lower in December and there was this big pickup in January in the delivery recovery?
No, so we continue to work on initiatives to drive delivery growth. We had started our initiatives from day one as COVID set in. So we started our no contact delivery, started working with the platform to drive growth. And some of our initiatives have started to come through. As I said, from a forward-looking perspective, the big strategic initiative will be to drive our own platform, grow them, build the whole app business, and continue this growth on delivery. And part of this is also consumer behavior, right? We've seen that shift happen in due course of time, where the shift has happened. And as Srinivas mentioned earlier, we were also on television with a Whopper campaign in the month of January. That also gave us a bit of a lift in sales across our channels.
Also, Arnab, policy, what we've learned from Raj is we'll refrain from commenting on competition, good or bad, either ways. So what Kapil is sharing is what we did to kind of grow this piece, whatever the number was for industry, it was there.
Yeah.
Okay. Thanks, Prashant. Thanks.
Absolutely. Absolutely. Be addressed that Kapil, is building a great team now. We're going to have a few more people on the team very soon. I think next week you're getting your talent on into. So we're building up a very strong infrastructure to drive our digital business. We're just not putting lip service to this. We have now a chief digital officer in this company. He's building a complete digital team. This is not going to be outsourced or anything. This is going to be a team sitting inside in our company and driving this business. We were the first ones with the aggregators. When we opened the restaurant, we were the first one. And right at that time, we invested in complete integration of our technology with the aggregators. And now Kapil, with his talent, is coming in and enhancing all those things. Just as an example, the download speed of our app was significantly improved, and the size of that app was significantly decreased so that it could sit in, phones with much less memory spaces, so everyone could download that app. So a lot of that kind of work you're seeing, and you'll continue to see that. You're talking about the 86 going to 106 from December to January, and please, you'll continue to see that because we are investing time, resources, energy, and a lot of passion around this business, and you'll see that grow.
Thanks so much. All the best.
Thank you. The next question is from the line of Madhav P. from Spark Capital. Please go ahead.
Hello, sir. Thanks for the opportunity. I have two questions. Firstly, this is on the store economic. I know you did have, a couple of other participants also, did have questions on this front, and you also answered partly. But what I wanted to understand is, so currently our, store level margins are around, say, 8.5%. Obviously, there's this whole operating leverage portion, on the company level and corporate overheads kind of thing. But, even comparing to, say, though something like Domino's, though it's not a peer-to-peer comparison, right? For the same amount of throughput, what we currently do vis-a-vis them, their margins are, say, their store level EBITDA is, say, somewhere between low to mid-20s, and ours is high single digits. I fully agree it is not comparable, it's not apples to apples. But I'm just saying in terms of if our EBITDA should somewhere, is there a goal that this high single digit can go to, say, 14, 15 on the store level? And how is this going to be possible? So some pointers here. And so secondly, you were speaking on the whole omni-channel part, right, with the app coming in, and currently with 40% of our revenues from delivery, so there's a significant payout which we make to the aggregators. So is there a game plan here where with more and more people ordering on our app, and we would be doing the delivery ourselves, is there another EBITDA margin play here too? These two are broadly what I had in mind.
Sure, Madhav. Madhav, on your store economics, what that number is, as I mentioned to somebody else on the call, just wait out another 12 months and you will see the first side of where we are going towards. As I said, it's tough for me to comment on individual numbers over the next 12 to 14 months, but the directional, the big delta you will see itself in FY22. Just be patient for at least 2 quarters and you will see that. What that number is also, you will get a flavor, and I just ask you to keep a small thing in mind that the number that you will see that we report is a portfolio-wide average. And if you do just a small match of the number of stores that we opened over the last 3 or 4 years, you will get a sense what those the stores that we opened 3-4 years back are doing. Obviously, it's a curve that moves up in that sense. So I would refrain from making guidance on a restaurant operating level, but the trajectory is northwards and significantly higher. When you spoke about the app side, we mentioned what we kind of wanted to kind of tell you. As I said, it's still early days for us. On the store economic side, it's not just us, QSR as an industry. If you go to a Zomato, Swiggy, we also recover a certain part of the money from the customer by way of delivery charges. Is there a cost to doing delivery as a business? Answer to that is yes. However, if you will see, the products on the delivery side are priced higher compared to dine-in. So the way you do the math, and I will share just one broad data, the cost of doing delivery as a business today is about 8% to us. So we are using the same infrastructure to generate 40% more revenue, and the incremental cost gross margins remaining same is about 8%.
Right. So, I'll give you a, anecdotal example. If this business of delivery is basically bringing convenience down into the doorstep of people. So this is not, in spite of, this is not replacing a dine-in business. This is in addition to our dining business. So this is additional business. This is the way you have to, as finance, executives, you have to look at this business as a add-on, additional business on top of what we are amortizing, rent, capital, all that in the restaurant. This is additional, business that comes from outside that we tap into. Now, if you see, if you look at the COVID, and that's one of the graphs we gave you on page number 13, when we first opened the restaurants post-COVID, in April, 100% of the business was delivery business because they didn't allow people inside in the restaurant. But that business didn't go from being, 30,000 rupees or 40,000 rupees to 100,000 rupees. It was what it was, right? And as you see, this business in January has come down to 38.62. And that is as you can see that, it's coming back. The dine-in business will come back. Traditionally, you will see this to be at about 70-30 kind of a business, and I think we'll get there at some point. Yeah?
Yeah. Sure, sir.
Yeah.
Thank you.
Thank you.
Thank you. The next question is from the line of Varun Singh from IDBI Capital. Please go ahead.
Yeah, thank you very much. Sir, I just wanted to understand in terms of, what kind of a degree of control that you wish to build into your entire ecosystem. So, for example, currently, if we order from Zomato, we see a Zomato guy delivering to us. So going forward, do you wish to control this entire last mile delivery, or you wish to keep it as it is, as we are experiencing it currently?
Yeah. So the way we think about this is the way the consumer, the guest or the customer, whatever you want to call our consumers, the way they want to approach to us, not the way we want to do it, the way they want us to do it. That's the best way to look at it. So today, a consumer wants to, access us through Swiggy, which is a marketplace, or Zomato, which is a marketplace, or they want to come down to our own app. They should have the complete flexibility to access us from wherever they want. And that's a very simple way for us to make sure that we reach to every last consumer that wants to access us. So that's one thing. Yes, we want SOPs. We continue pushing ourselves. Once, Kapil has his platform in place and we have done our performance marketing and it's on every consumer's, phones, there will be incentive for people to order from our app because there will be a loyalty program. They will be collecting crowns or points which they can redeem for food. There's going to be previous orders that they can just press and say, I want to repeat this. There's going to be a lot of convenience that will drive people. And also, I think Kapil plans to have certain offers that will only be available on our app, right? So a lot of that will be there. But again, just coming back, we want to make sure that we are still on all the aggregators because that's some people like to access brands through aggregators. So we will continue to be there. We'll continue to partner with them. We will also continue to push them on making sure that their delivery last mile is done better and better. Our SOPs will get tighter and tighter and better. And we've got some very good partners in both of them. So we will continue working with them to make this a stronger business with them as well. And the SOPs, the standards that Burger King will set over the next year in terms of delivery will be something to watch out for.
Sure. And sir, second question is, currently we see that on Zomato there's an entire different set of menu compared to the menu that we see on your website. So why is this difference and how do we intend to keep this? What would be our distribution strategy? If you can make some commentary on that. Thank you very much.
Yeah, just to answer that question, the menu is not dramatically different. It's just a couple of SKU, again, driven by consumer choice, right? These are the buying patterns that we've studied over the years. Obviously, we've been with the aggregators from day one, from 7 years now. So we studied the buying patterns and, built in some SKUs which customers prefer, right? And yes, on our app as well, as we build more data and understand our consumers better, we will be optimizing and, sort of personalizing our menu options based on customer preference.
It's an intelligent system so that and all of them have this intelligent system, which is basically as it learns what the consumer really wants, that's what it shows on the first as you open the app. So it's a learning system, it's an intelligent system, and it works just like most e-commerce companies. All right?
Guys, we can take one last question.
Thank you very much.
Sure. Ladies and gentlemen, we'll take the last question from the line of Amnish Agarwal from Prabhudas Lilladher India. Please go ahead.
Yeah, I have a couple of questions. My first question is that you gave a statement that you have mostly exhausted the stores which could be opened in malls. Now, looking at the condition that the incremental addition to stores will be more on the high street, plus some of the earlier locations like your IT parks or even metro stations and all, they won't be having you can say, the crowd as they used to be in the pre-COVID scenario. How does it change the overall, you can say, store economics and viability for us? This is my first question. And my second question is basically the data point on that what was the share of delivery in the overall sales pre-COVID and any guidance on the tax rate given that we have a lot of accumulated losses in our balance sheet. Thanks.
So Anish, Prashant here. Yes, mall today is a larger share of our total portfolio because those were the low-hanging fruits when we entered into India. As we move forward, you will see higher contribution coming from the non-mall portfolio side. However, when we kind of provided you the guidance in terms of same store, and all the numbers that I have been telling you that have been provided, keeping the new product mix in perspective, as I said, two significant drivers for restaurant operating margins are going to be rise in gross profit margin and operating leverage at a rental side, and then of course at a company EBITDA more at a corporate cost side. So all those has been factored when we shared those numbers with you. What was your second question, Avnish?
Second question was basically the data points on what was the share of delivery sales in the total in the pre-COVID area and the tax guidance given that we are having accumulated losses.
So pre-COVID, we were at roughly about 30 to 33%. We are currently at about 38. And as Raj mentioned, over the next, slightly longer, near term to longer term, we see this settling at about 35 odd percent. That's our belief.
And the growth rate, when we give a growth rate, and we say, we're going to grow X percentage over the next year, it applies both to delivery as well as dine-in business. So it's not that we are expecting a complete shift from dining to delivery. I think we expect both the businesses to grow. Okay? Thank you very much. That was a good question. With that, go ahead. Okay. Is there anything else?
Any follow-up, Avnish?
Avnish has left the queue.
Okay.
Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah, so I'll hand it to Prashant in a second here just to do the closing comments. But I just wanted to thank everyone. Look here, the support we have received, from the entire community, whether it's the investment, analytical, the banks, you name it. I'm really humbled, very humbled as the CEO of this company. I thank everyone for standing behind us. We promise to be as transparent as we can as a company, where information is, kept to protect the investors, to protect the company's, growth. We'll protect that information, but we have no objective of doing anything else. We are an extremely transparent company and will continue to be transparent moving forward. And we are extremely happy for all the support we have raised. So thank you so much, and I'll turn it over to Prashant for closing comments.
No, sir, nothing more. So thank you guys, and look forward to interacting with you in the next quarter's conference call. Thank you. Appreciate it.
Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Edelweiss Securities, that concludes this conference. We thank you all for joining us, and you may now disconnect your line.